Well, good morning, everyone. Thomas Montgomery. It's a beautiful Friday morning. Today is January 16th, 2026. Most, but not all, but most weekday mornings we get together at 8 o'clock Central, talk about the grant, talk about financial literacy, talk about how we can help people get money to start and grow a business. Today, we're going to talk about an incredibly important topic that even if you've been on our past Zooms, I bet we're going to cover some information today that you're not aware of that's important to know. And then furthermore, we're going to show you kind of a loophole of how we can structure business loans to get a lot more money than people would be able to otherwise legally and ethically. So, our topic today, as stated, is business loan structuring 101, which just means the basics. So let's start with defining, well, what are we talking about here? What is business loan structuring? Well, when an entrepreneur is looking for money for business funding, there is a critical decision that needs to be made in how we're going to set up the funding request. Because we're going to have to present to the lender, here's how much money we're asking for, and here's what we're going to use it for. Based upon what we tell the lender in terms of the dollar amount and the anticipated uses is going to then impact what type of documentation is needed. You all, we have 519 of you on this morning. You all are very sophisticated, but not everyone has the education, the experience, the knowledge you have. You'll run into some people out there who say, no, I just want $1 million. And as we start to try to dig into it, sometimes they can be dismissive. No, 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 I just want $1 million. Well, that's unrealistic, right? We're going to go to a bank, a financial institution, say, here's this client, and they just want $1 million. It's not going to get approved. We're going to have to build the story, to have the loan package, to explain what it is that we're going to use the funding for. So let's talk about some common loan structures, and then we'll get to our loophole that can work really well that you might not have considered before. So let's say that we want money for real estate. We want to buy an apartment building, an office building. We're talking, of course, commercial real estate, not residential real estate. Now, you could buy residential homes and then lease them out as a landlord. But let's talk about CRE, commercial real estate. Well, the great news about real estate as a loan structure is we can go get a lot of money, millions and millions and millions if we need, because the real estate serves as its own collateral. And as long as the real estate appraises for what we're wanting to borrow, it's usually pretty straightforward. So that's a benefit of that type of funding. But there's also a con. We have people that sometimes come to us and say, okay, I want $1 million. I just keep using that as an example. I want $1 million for real estate. Oh, great. What's the street address of the real estate you're buying? Oh, I don't know. I've not found it yet. Well, that's not going to work. The con that we're identifying here is if we want to get real estate financing, normally we need to know what the real estate is because the real estate's going to serve as the collateral. It's not going to be just some open-ended, oh, here's $1 million, and when you find some real estate, let us know. So normally we need to know the details about the real estate. It's going to have to be appraised and approved. Also, when we do real estate financing, it's normally restricted. And when I say restricted, I mean, does the money have to be used for something very specific versus general? So, could we say that we want real estate financing for $1 million and then take that $1 million and go use it for something unrelated? No, typically not, because the lender is expecting details about that real estate and they're going to put a lien against it. So, is real estate financing bad? No, but it's one type, but it has some consequences that limits its applicability for some of our clients. Another type of common loan structure is business acquisition financing. So there's a business out there that we want to go buy. So we're not starting, we're not creating, but we're going to go acquire an existing business. Well, another pro similar to real estate is, man, we can get a lot of money to buy an existing business. However, similar to real estate, we're going to need the details. And again, sometimes I'll have a client says, well, I want $1 million to acquire a business. And then we'll ask, oh, great, what's the name of the business that you want to acquire? And usually it's like radio silence. I don't know yet. Well, we can't use business acquisition financing without a business to acquire. We can't use real estate financing normally if we don't have specific real estate to acquire. And again, it's restricted. So those two kind of operate very similarly. Same with equipment financing. So with equipment financing, again, we can get lots and lots of money to go buy equipment as long as the equipment, it's worth what we're paying for it. Same type of con, we can't go ask for $1 million, for example, of equipment financing and just go use it for something else. We're going to have to we're going to know what equipment we want to buy. We're going to have to explain that to the lender, and then we're going to need to actually use that money to buy the equipment. So, as we build financial literacy, and I know most of you know this, we can't go ask for real estate financing, business acquisition financing, or equipment financing just because it sounds good and then use the money for something unrelated. That's not going to float. But if that's what we actually want the money for, then those each can be very, very good. There are certain types, now we're on to a fourth type of a common loan structure. There are also some niche financing that's much different than anything we just discussed, whereby the approval process is on something very narrow and specific. Some of you are familiar with revenue-based financing. So if a business has enough deposits already coming in, that can itself get an approval for a loan. Separately, if a client accepts credit card payments, just their merchant card experience could be enough to get them approved. So that's another example of a niche not listed. Asset-based lending, if we have enough of a qualifying asset, we can go get financing off of it. So those are some niches that are very attractive, but we do have to qualify for those. Those usually are going to be unrestricted. So if we got money through, for example, revenue-based financing or asset-based financing, normally we can do whatever we want. The lender doesn't care. The kicker is we have to have enough revenue that qualifies or enough assets to qualify to get that. So all that's pretty common, and you probably all pretty familiar with that. Now let's get into working capital loans. A lot of clients will come to us once we've educated them and say, okay, I really want to go buy some real estate, or I'd like to have the flexibility to acquire a business or maybe get some equipment, but I don't know the details. Why don't we just call it a working capital loan? Wouldn't that be great? Well, let's talk about working capital loans. So the great thing about working capital loans is it is generally unrestricted. It's normally, okay, here's a lump sum amount. It's wired into the client's account and they can use it pretty much for what they want. It's the opposite or very different from these other types that are dedicated to a specific use of funds. However, we can't just go to a lender as we started our conversation, say, I want $1 million, give me $1 million, and just expect without some detailed documentation of the use of funds that they're going to approve it because they're not. I mean, you'd have to be if Walmart went to their lender and said, I just need an extra $1 million, they would just get it. But for the normal business, there's not going to be so much trust and confidence that they're not going to want details. So we have a little asterisk here on working capital loans. So while it may be desirable to structure every loan request as working capital, as I mentioned, the lender is going to typically require a loan package that has documentation that supports the request, especially if it's a large amount. If it's 25,000, there's a good chance that there's not going to be many hoops to jump through. But if we're talking large amounts, which we normally do, the lender is going to want to know, what are you using this for? But the interesting thing is, once the money comes in, there's usually no restrictions, so you could use it for whatever you want. So I'm not saying we should ever lie, cheat, or steal, but you can read between the lines. You could theoretically create a use of funds that says A, and if circumstances change, you get funded and you use it for B or C or D, some alternatives use. There's typically no consequence for that. But it's hard to go. So you might conclude, well, Tom, why don't just everyone just go get millions of dollars of working capital loans? It gives them the greatest flexibility, right? Why bother with these specific types? Let's just get the general umbrella type. Well, that becomes increasingly difficult to justify as the dollar amount becomes bigger and bigger. For 100, 250,000, yeah. But when you get larger and larger amounts, to go to a lender and just say, again, use that same example, I need $1 million of working capital, we're going to have to kind of support that to justify that. So it's not real easy to go get massive amounts of working capital. Now, it is common to get working capital loans in addition to some of these restricted types. So if the primary use is to go get real estate, but we also need money to rehab and to market our apartment complex and so forth. So some of these can be combined, by the way. All right, so I want to show you a loophole that works 100% of the time to get these deals approved, and it's based upon the loan structure. So let's go through that. So the first bullet here is, let's say that we wanted to go open a franchise, whether it be a Domino's Pizza, a McDonald's, what have you, a specific kind of replicated business, commonly referred to as a franchise, but sometimes it's a license-based relationship. So these are some of the easiest financing deals to get because the business model is already laid out, it's already proven. It's just you have a new entrepreneur applying that established business model in a new place. So we're going to talk about the concept of branch office financing. And in fact, that's the little logo here at the top. How can we use branch office financing to help your clients get large amounts of capital that's unrestricted? So let's continue on. So, as I insinuated, lenders often have confidence. They prefer when entrepreneurs are plugging into a well designed and supported business model rather than trying something on their own. So, a simple example, we've got Amanda on. So let's say Amanda's deciding, do I want to go open a Domino's pizza franchise in her town? Does she want to in her town? Or does she want to just skip the Domino's and start a pizza restaurant from scratch? Well, it's whatever she wants to do, but it's going to be always easier to get financing for a Domino's franchise than it is for her developing something from scratch because the lenders are going to have more confidence that that Domino's pizza is going to be successful than what Amanda might be doing for the first time in her life, especially if she doesn't have a lot of background in that. So, what becomes incredibly important for loan approval, especially for working capital loans, is feasibility data. And we've talked about this in some prior trainings, but it's been a while. So, when we say we want $1 million for something, we're going to need to be able to show the lender what we're going to use that for and how we're going to be able to afford to pay it back. And with that, there's certain assumptions, where's our sales going to come from, how many new clients, and so forth. So, what sophisticated loan packages have is not just a bunch of assumptions or a bunch of numbers, but real market data to support the assumptions. That makes a huge difference in getting working capital loans approved. And as I've inferred, I think we have perfected how to help anyone get a working capital loan for large loans. And we call it the branch office model. So hear me out. You may have some preconceived notions of what that means, but I suspect it's not accurate. So hang in there. And we're going to go through how to help any entrepreneur get large amounts of funding structuring it off of this quote unquote branch office approach. Make sense? Okay. So let me go ahead and forward it to the top of the page. So what we do is we structure these as license agreements. They're not franchises. So it's not set up the same as getting a McDonald's or a Domino's where you have to buy their signs and follow all their very restrictive guidelines. So first thing you need to know about the branch office model of funding is it's not a franchise, it's a license-based agreement. What we're doing, of course, with no out-of-pocket cost, is we're setting up quote unquote branch offices. Now, if the person actually wants to run the branch office or not, it's up to them, but we're using that as the structure. And the funding then goes in $250,000 increments. So, what am I saying? For each branch office that we document that an entrepreneur is going to own, we can get 250,000. So you might say, well, what if the client needs 1 million? Well, then we're going to need to show that we're going to have 4 branch offices. And you might say, well, that seems complicated. Why do we want to do that? Why don't we just say 1 branch office for 1 million? Logically, the math doesn't work out, right? If we're going to form this theoretical, or it could be real, branch office, there's only so much cost that's really needed. And I know from the client's perspective, they want to throw caution to the wind and bigger is better. But it's got to make sense to the lender. You can't just go ask for this incredible amount that doesn't make sense. So we break this down into we would do 1 branch office equals 250,000 because we're going to detail the intended use of funds, but they'll be unrestricted so the client won't be stuck with it. So let's go ahead and go through how the branch office concept, it's really a loophole to help clients get a large amount of funding legally and ethically. So let's go through it. So like McDonald's or Domino's, it's easy to get franchises funded because there's some parent structure that's figured it out, and now they're just duplicating that in a local market. So we have proven the branch office model, and we are, I guess, what you call the licensor, and then the client is the licensee. And again, you might say, well, why do we worry about all this? Because we're trying to build the substantiation to get approved for a large loan. And we have to tell the story that makes sense. So part of that is having an LOI, a letter of intent. So if we wanted to go borrow money to open a McDonald's franchise, we couldn't just say, hey, get me that 3 million because I'm thinking about getting a McDonald's franchise. It'd never get approved. But we'd have to go to McDonald's, get pre-approved, have an LOI, then we can go get the lending, and then we can go execute the strategy to open the McDonald's. So with the branch office concept, we are restricting to 1 per county. And again, the individual can operate the branch office or not. They should and they could, but they don't have to. But that's the structure for funding that we're using. We issue a letter of intent, which most lenders are going to require. And then we're going to also upfront provide for the first 25 clients worth 10,000 apiece. So that's literally putting the first $250,000 of income into that branch office. And that also can be pledged as collateral because a lot of these people, they don't have collateral that's needed. We're providing the collateral, not in the sort of form of defaulted or non-performing receivables, but in the fact of true executed active client agreements. We also, because we know a lot of people don't want to spend time running branch offices, they really just want to use this strategy to get a lot of money. So we will also take responsibility for developing the leads because we've proven we had a training a couple weeks ago where we talked about the amazing statistics that we're getting with our online ads. So we'll provide the first 25 clients. They'll already be under contract, so we can document that in the letter of intent. And then we also will take care of the ongoing client development. So again, this removes the burden of the entrepreneur, of the applicant, from being able to prove that they have prior experience. So we're able to piggyback off of our experience of working with SBA, SBDC, and or SCORE off of their governmental models that we're now privatizing. And that makes sense because in each county, which is the service area of each branch office, there is a need for better financial literacy and access to capital. And we're able to go in and quantify how many small businesses are starting on average per year. With our feasibility data, we'll look at what resources that exist. We're going to be able to justify the need. So we're taking what the government has done through these organizations and making it a private model that is formed as a branch office that is owned, doesn't have to be operated, but owned by the client. Some people say, well, isn't this gonna compete with banks and credit unions and lenders? No, not at all. We're gonna work with them and actually get referrals from them because we're not proposing to go open a bank in every county across the country, but instead we're going to open what we call the technical advisory services. This is also important, and I'm not political, nor is our organization, but I think you're aware that President Trump and our current administration is reducing government funding and reducing staff of many departments and even eliminating some departments. So I'm not here to judge that or anything like that. But the point is, there's an unmet need by the governmental resources that exist, plus those are often shrinking or being eliminated in many areas. Again, it's important. This is a bit of an advanced strategy, so you need to understand. So, if you wanted to leverage, or you had a client that wanted to leverage this to get funding, they can actually open a branch office and actually operate it if they want, or they don't have to. We would recommend you wouldn't go buy a Domino's pizza franchise and leave the lights off. So I think a better and or approach would be either the entrepreneur actually wants to run it, which will be rare, but sometimes, but more often they just want to own it, right? You and I could go open a McDonald's and not ever go to work there. We could hire a manager, a general manager, a manager, assistant managers, and let it just operate, and we just own it. So it can be active income or passive income. We provide the 250,000 of working capital per branch office, as I described through up here. Plus, it's designed, the financial forecast, the model, the feasibility data supports that it should be bringing in at least 100,000 a month in profits, not just in gross income, but in profits, which of course is 1.2 annually. Now, again, I know we're kind of bringing together two different models. How do we get approved for a loan? And then how does this branch office fit in? Well, hopefully, what you took from our earlier discussion is you can't just go ask for a big loan. You have to substantiate it. Some people don't have a good plan or a structure to substantiate it. This will work 100% of the time. We guarantee it. So you can the entrepreneur can actually draw a salary if they want, and then as well pull out the excess profits. So it's producing cash flow. They don't have to run it. We can help them hire an executive director if they don't want to do it themselves. No, there's no prior experience, and that's important. A lot of loans like SBA, the SBA normally won't loan money to someone that doesn't have a background or an education in what they're wanting to do going forward. In this model, like you can go get a Domino's pizza franchise loan, even though you've never owned a pizzeria, because you're plugging into an existing model. That's what we're doing here. And we actually bring the training on site to the branch office to make it convenient. As I mentioned, these are unrestricted loans. So once the client has received the funding under the branch office model, they can execute the branch office model or not, but the funds are available to be used however they want. Now, we put together a very detailed loan package that the lender will approve that shows, yes, we're going to need an office and we could either buy or lease it. We're going to need to cover payroll, equipment, professional fees, maybe we want a company vehicle, training. So we have to put together an outline of why we need 250,000 per branch office, but in truth, the client doesn't have to use the money in that way at all. So, how would we go about leveraging this as we wrap up our discussion today? Well, first of all, I want to emphasize that there is no out-of-pocket cost. What would happen is there is a branch office deposit that is going to hold the territory, which is for a specific county. And some people might say, well, if the branch office really isn't meant to operate, although it could be and should be, it's just meant to get funding, then why do we need to have a territory? Because we have to create a story. And if we didn't have territories when we went to the lender, then we couldn't say that this branch office is going to control this territory. Here's how many banks, here's how many SBA loans have been loaned, here's how many new entrepreneurs. So we need definitiveness. The key to getting business funding is a very tightly developed, very specific loan package. So there's a deposit. That deposit is not paid out of, it could be, but it doesn't need to be paid out of pocket. We finance that. And that's going to be important again for us to issue the LOI. Because what did we say earlier? Lenders are not going to loan a lot of money for a business concept if there's not enough substantiation that it exists. So the LOI is crucial. The 5,000, which can be financed, provides the territory hold and the feasibility study. The total cost of the branch office is not cheap. It's actually 25,000. But we do not charge performance fees for these capital raises. So if you do the math, normally when people come to us and they do a $250,000 capital raise, normally what's happening is they're paying a 10% performance fee. Well, what's 10% of 250,000? It's 25,000. So it's still coming out of the capital raise. It's not paid out of pocket, but it's structured differently for this to work. For those of you that are affiliates or referral partners, you might say, well, if there's no performance fee, how do you get paid? Well, we pay you out of that license fee, is what happens. You still get paid generously, but it is a different structure. So next week, we'll continue to dig into this a bit deeper, talk about how you can help us open branch offices if you wish. You better understand the design, how you can get paid out of that 25,000 and answer additional questions. But I wanted to introduce that today. It is a significant strategy for many entrepreneurs that lack a loan structure based upon their own resources that will work. This will work, and we guarantee it. Guaranteed 250,000 raise per branch. All right, with that being said, thank you for your time. You can always reach out to us if you have questions, but we'll continue this discussion on Monday and dig another layer deeper. But certainly feel free to let us know if this is something that you're interested in, and we could go ahead and get everything set up where you have your LOI, and it would be an LOI per branch per county. So it is important, and we'll dig into this Monday. So if you want more than 250,000, as I mentioned, it goes, we can only substantiate that makes sense to the lender that we need 250,000 of working capital per branch office. So we do have to duplicate the process to get to those higher amounts. Thanks, everyone. Have a great day, great weekend, and we'll resume on Monday. If you're wanting more information between now and then, give us a call. Thanks, everyone. Have a good weekend. Bye.